G'day guys, welcome back to the Devon Too Good Investing channel. So over the last few days I've been going through Alibaba's December quarter 2021 earnings results. So I've had a look at the earnings presentation and also the investor call. And overall I'd say the earnings were, look, in terms of revenue, there's definitely a fair bit of slowdown in that department. But then some of the losses that the company experienced weren't as bad as what many investors thought they would be. So straight off the bat, Alibaba, they somehow they grew their annual active users by 43 million. So now they've got a annual user base of $1.28 billion, which is just incredible. It's insane how they're able to pull more and more users to their platform, and a lot of this user growth actually came from some less economically prosperous tier 3 Chinese cities. They saw very quick growth with their Taobao deals, which is almost Alibaba's answer to what Pinduoduo offers, and that's where a lot of their user consumer growth came from. In terms of revenue, they actually delivered one of the slowest revenues since Alibaba has became a public company. They grew 10% year over year, and later in this video we'll have a look at the segments and see they did grow slower in China, but the international markets did grow a lot faster, but we'll get into that in a second. And the company has initiated more share buybacks. They purchased 10.1 million ADSs, which is approximately worth $1.4 billion this quarter. Personally, look, it's good to see. I would love to see them purchase more shares, especially given how far the stock prices came down, and it is trading at a very attractive price, Alibaba, at the moment. So look, to me, I'd like to see this increase, considering they do have a lot of money on the balance sheet there. So if we move to net income, or income from operations as they call it here, we can see that there has been a large decrease of 86% year over year. This is due to a impairment of goodwill in relation to digital media and their entertainment segment. But if we exclude this impairment of goodwill, it is a decrease of 34% year over year. They also go on to say the year over year decrease was primarily due to investments in growth initiatives and increased spending for user growth, as well as support to our merchants. This is something that shouldn't be a surprise if you're a Alibaba shareholder. The company all year has been increasing their spend on growth initiatives and spend on user growth. You could argue that maybe it would have been better not to spend some of this money, but anyway, we have seen an increase in user growth, so maybe we can't be too critical, and competition is strong in China, so it is probably necessary for them to continue to spend the way they're spending. Net income down 74% year over year. Is mainly due to the same reasons I just talked about, and also due to the net. Well, they say decrease in net gains. Well, it was a net loss in terms of the equity investments that they hold. But if we look at the non-GAAP measures, that does not account for that. We can see that their GAAP net income decreased 25% year over year. This is mainly due to the increased spend on growth, essentially. If we have a look at the non-GAAP free cash flow, this is probably, you can't be mad about this. They had free cash flow of 11 million in the quarter. It was a decrease of 26% year over year, but this decrease, as we already mentioned, was due to the increased investments in growth initiatives and spending on user acquisition. So, well, if you think about it, right, Alibaba trading at about 300 billion. If they're doing gap 3 cash flow of 11 billion, if we take away some of the cash in the balance sheet, you're looking at an enterprise value of about 270 billion. If you were to multiply out the gap non-gap 3 cash flow, you're trading at a pretty damn cheap multiple right there. So even though growth might be slowing on this business, it is still producing a lot of free cash flow. Now let's have a look at some of the different segments. And I actually like this new way Alibaba are reporting their earnings. I like seeing all the different segments and how they're performing. In terms of China commerce, one of the most impressive things was that they were able to increase their their active annual customers. So they increased their customers by about 20 million, and this was driven by Taobao deals. And we can see Taobao deals actually grew their orders by over 100% year over year. So that's just insane. And it's crazy because they started this business pretty much this year, if I'm not wrong. And they're already at 280 million annual customers. And that's up 39 million from the previous quarter. So, I don't know, it's just insane how, Alibaba was able to, create this Taobao deals and already get it up to 280 million annual customers. Is 280 million is, that's just a crazy number. Like, it's hard to get over that, but nonetheless, they did it. Their Tao Kai Kai, it grew GMV 30% quarter over quarter. And this is actually a very untapped market in terms of sort of digitization. And what it is it allows customers to purchase food and groceries and fresh produce and that sort of thing. So, this could be an area for penetration for Alibaba in the future. We might see future growth. And those two initiatives will probably mainly drive the Chinese commerce right there. If we move to international commerce, I'd say it performs pretty strongly. International retail, this includes Lazada, AliExpress, Trendyol, and Daraz. They all grew strongly. We're now sitting at annual active customers of over 300 million. And look, collectively, these businesses grew order growth by 25% year over year, mainly pushed by Lazada and Trendyol. Trendyol? Now, these names, but anyway, guys, like you can't be mad about this growth. Lazada doing really well. Trendyol, this Turkish e-commerce company, they would be suffering a little bit from the Turkish lira devaluation. But look, Lazada, strong business. International wholesale grew around 50% year over year in terms of transactions completed on Alibaba.com. This was driven by solid export growth of consumer industrial goods from China to other major developing countries. And they were also able to increase their revenue 29% year over year. So if we look at Kai now, this is their logistics business. This helps solidify sort of the e-commerce businesses in China that Alibaba owns. This allows them to, get goods out to their customers in a really fast, sort of competitive time, even into rural areas, which is very impressive. And it grew 23% year over year in terms of revenue. And revenue from their inter-segment elimination grew 15% year over year. So now onto the cloud business. Total revenue from the cloud business before inter-segment elimination, which included revenue from services provided to other Alibaba businesses, was an increase of 19% year over year. And if we're including the after inter-segment elimination, they grew 20% year over year. This is solid growth. Maybe not as fast as what some people likes, but they are reporting slower adoption from some of the internet companies. However, they are diversifying into non-internet company customers. They have also diversified their revenue overall. So non-internet industries accounted for 52% of Alibaba's cloud revenue, while internet industry customers accounted for the other 48%. In terms of data centers, they established 2 new data centers, one in South Korea, the other in Thailand. And they've currently got computing services in over 25 regions. Data and entertainment, we can see this grew. They grew their average daily subscriber base on Youku's by 14% year over year. And if we move down to Alibaba Pictures, they participated in the production and distribution of over 70% of China's major box office movies in the quarter. So if we look down here at cash flow, we already talked about this before, but they produced free cash flow of $11 billion. And as mentioned, this was mainly due to a decrease in profit as a result of increased investments and growth initiatives and our increased spending for user growth, as well as support to our merchants. And look, they yabber on more about share repurchases. They're going to purchase some more shares this year, I would imagine, or this coming 12 months. But overall, yeah, I think they should be repurchasing more shares. That would make me feel a bit better about sort of. I'd like to see the management take more advantage of this current stock price. That's pretty much what I'm trying to say there. But I'd say overall, revenues for the Chinese business slowed a fair bit compared to what they've been growing at previously, but they are starting to cap out how many users they can have, as pretty much everyone with internet in China is already pretty much a Alibaba customer. So the only way to grow revenues off that is either you create new products such as Taobao deals, or you increase the average spend per customer. And yeah, apart from that, like, that's, I can't see much other ways of growing out the China e-commerce segment. In terms of the cloud segment, I think there's quite a large runway there. I was reading in the presentation that Alibaba put out, it is predicted that the Chinese cloud business will 5x from where it is now. The total addressable market, sorry, not the Alibaba cloud business itself, but the entire cloud business in China. It'll be worth about 1 trillion RMB. Right now it's worth about 2 trillion RMB. So if Alibaba just holds its market share, we should see very significant growth in that business. And damn, like, by then, it could be a really significant business for Alibaba, and it could even be worth the current market cap right now, if we're being honest. So if we have a look at where the market is currently pricing Alibaba, this is my discount free cash flow model. This is using free cash flow from 2020, which is probably a little bit higher than what free cash flow will be this year, but very conservative growth rates, 10 to 14% for the business. I I think Alibaba might well grow more than this, but I like to be conservative with my models. We're going after a 22% rate of return. I've put in the current shares outstanding, a fairly conservative terminal multiple. I've put in net cash. I've made an account for the fact that Alibaba owns 1/3 of Ant Financial, and I valued that conservatively at about 30 billion. And based on these, we're getting buy prices of between $133 and $150. Um, it's look, it's insanely cheap. It's just whether you can stomach the risk that the CCP sort of provides. I have added a lot of videos on YouTube and a lot of opinion about that in the past, so have a look at my Alibaba playlist and you'll find those. I'm not going to go over those again in this video. Perhaps I can do an update on those in the future. But guys, like, I feel, look, the revenue's slowed. They're spending a lot more money in trying to grow the business, which is decreasing free cash flow. But at the end of the day, they still produced 11 billion in free cash flow just in this quarter alone. The stock is incredibly undervalued. It's just a matter of whether you can accept the risks and whether you're comfortable with, having your money in a Chinese company. A lot of people aren't comfortable with that, and that's fine. But for me, the risk reward is there. It's all about managing your risk though, and not going too heavy into a position that could potentially be taken away, which I think is very unlikely. But look, I've been wrong before and I'll be wrong again. So anyway, guys, thanks for watching and have a good one.